In 1976, a quiet idea emerged that would change investing forever.
John Bogle introduced the first index fund designed to simply follow the market.
Strategies. At the time, most investors believed skilled managers could always beat the market.
But a radical idea began spreading. Instead of beating the market, simply own it.
That simple philosophy would later become the foundation of passive investing.
Throughout the early 1980s, index investing slowly gained attention among institutional investors.
Financial innovation accelerated as new derivatives began shaping modern capital markets.
Still, most investors remained loyal to traditional active fund managers.
Yet quietly, index funds continued to grow with lower fees and simple market exposure.
A new generation of investors began questioning the cost of active management.
During the early 1990s, investors began studying how few active managers actually beat the market.
In 1993, a new product appeared that would reshape modern investing.
The first exchange-traded fund allowed investors to buy an entire index like a single stock.
This innovation made index investing faster, cheaper, and easier to access.
By the end of the decade, passive investing was quietly gaining momentum.
By the year 2000, index funds had begun attracting attention from long-term investors.
Yet most investors still believed skilled managers could outperform the market.
Meanwhile, passive funds quietly offered broad diversification with extremely low fees.
Exchange-traded funds began expanding into new sectors and market indexes.
Slowly, a structural shift in investing behavior was beginning to take shape.
By 2006, passive funds were steadily gaining assets from investors seeking lower costs.
Exchange-traded funds continued expanding across sectors, indexes, and global markets.
Then the financial crisis forced investors to question traditional active management.
In the aftermath, many investors began searching for simpler and cheaper strategies.
Passive investing suddenly looked like a powerful alternative.
After the financial crisis, investors increasingly turned toward low-cost index funds.
Exchange-traded funds began attracting billions of dollars from global investors.
Lower fees and broad diversification made passive funds difficult to ignore.
Derivatives linked to indexes further expanded the influence of passive strategies.
A quiet shift was underway in how investors allocated their money.
By 2015, passive funds were gathering assets at an unprecedented pace.
Exchange-traded funds had become one of the fastest-growing products in finance. Investors increasingly questioned whether active managers were worth the cost. More portfolios began shifting toward index-based investment strategies.
Passive investing was no longer a niche strategy. It was becoming the new standard. By 2020, passive investing had grown into one of the most powerful forces in global markets. Exchange-traded funds now moved billions of dollars every single trading day.
Many investors realized that matching the market could outperform costly active strategies.
Money was quietly shifting from active managers to passive index funds.
A financial transformation was unfolding across the entire investment industry.
By this time, passive funds were managing trillions of dollars worldwide.
Index-based investing had become central to how portfolios were constructed.
Many investors now preferred low-cost diversification over expensive stock picking.
Passive investing was no longer an experiment, it had become the industry norm.
A quiet revolution had reshaped the structure of modern investing.
Passive investing had transformed from a niche idea into a dominant market force.
Exchange-traded funds now represented a massive share of daily trading volume.
Large asset managers began building entire portfolios around passive strategies.
Trillions of dollars now followed market indexes instead of individual stock picks.
The rise of passive investing had reshaped the entire investment landscape.
Today, passive funds manage a significant portion of global investment capital.
Index ETFs now trade alongside individual stocks across global markets.
Into network class VA or investors. For many investors, matching the market has become the preferred strategy.
Low fees and diversification made passive investing widely accessible.
The quiet shift toward index investing continues to reshape modern finance.
Passive strategies are now embedded in retirement accounts and long-term portfolios.
Every day, billions of dollars flow automatically into index tracking funds.
For many investors, simplicity has replaced complex stock selection strategies.
What began as a controversial idea has become mainstream investing.
Passive investing now shapes how capital moves across the global economy. Passive investing continues attracting investors seeking long-term market exposure.
Index ETFs now trade across nearly every major sector of the market.
Large investment firms now build entire portfolios using index-based strategies.
What once seemed radical is now a cornerstone of modern investing.
The passive revolution has fundamentally changed how markets operate.
Today, passive investing stands as one of the most influential forces in global finance.
Exchange-traded funds now dominate many segments of daily market activity.
Entire generations of investors now rely on index-based investment strategies. What started as a controversial experiment has become financial mainstream. The passive revolution continues reshaping the structure of global capital markets. Passive investing has fundamentally changed how investors approach the market.
Millions of investors now hold entire markets through a single index fund.
Low fees and broad diversification made passive investing accessible to everyone.
A simple idea grew into one of the most powerful shifts in financial history.
The rise of passive investing reshaped global finance, and continues shaping its future.